Something happened in the silver market recently that a lot of people completely misread. Prices dropped sharply, and within hours, the headlines were already calling it a crash. Social media lit up. Comment sections filled with people saying the bull case for silver was finished, that the dream was over, that anyone who believed in higher prices had been fooling themselves. But here's what's actually interesting about that reaction. If you zoom out just a little, if you look at what happened beneath the surface of that price drop, not just the number on the screen but the mechanics behind it, the behavior of the market during and after, a completely different picture starts to emerge. And that picture is not one of collapse. It looks like the kind of reset that tends to happen right before something bigger begins to build. So today we're going to walk through all of it together. The flash crash, why it happened, what it tells us, what the market did right after it, and most importantly, what all of this means for where silver might be heading next. Because there's a number that keeps coming up in technical analysis circles, in commodity research reports, and in serious investor conversations right now. That number is $120 per ounce. And no, that's not a random figure someone invented to get clicks. There's a real structural case being built behind it, one that draws from supply and demand data, from historical ratio analysis, from chart patterns, and from the unique position silver occupies in the global economy right now. By the end of this video, you're going to understand exactly what that case is, where it's strong, where it has vulnerabilities, and how to think about it clearly without getting swept up in either the hype or the fear. Now, before we go any further, let me be very direct about something. Nothing in this video is financial advice. I'm not telling you to buy silver, to sell silver, or to do anything at all with your money. What I'm here to do is help you understand what's happening in this market, why it matters, and how to think about it as an informed person. Because most coverage of silver right now falls into one of two traps. It's either so technical and jargon-heavy that most people tune out, or it's swinging to the other extreme, all excitement and no substance. We're not doing either of those things here. We're going to be real, we're going to be thorough, and we're going to make sure you actually understand the story by the time we're done. Let's start at the beginning. Let's talk about what a flash crash actually is, because understanding the mechanics changes how you interpret everything else. A flash crash is a sudden, sharp price decline that happens very quickly, sometimes within minutes, and then partially or fully recovers in a relatively short window of time. What makes a flash crash different from an ordinary price decline is the nature of what drives it. Flash crashes are almost never caused by a change in the fundamental value of the asset. They don't happen because the company suddenly became worthless or because the commodity suddenly lost its real-world usefulness. They happen because of what's going on mechanically inside the market at a specific moment in time. Large automated sell orders, algorithmic trading that triggers cascading responses, margin calls forcing holders to liquidate quickly regardless of price, thin liquidity at an unusual hour, one large participant exiting a position in a way that temporarily overwhelms the available buyers. Think about it this way. Imagine a farmer's market that operates every Saturday morning. Most weeks, buyers and sellers arrive at roughly the same time, and prices for everything from tomatoes to honey stay relatively stable because supply and demand are more or less balanced. Now imagine one Saturday, a major wholesale buyer who normally purchases a large share of everything suddenly gets a phone call telling them they have a financial emergency. They need to unload their entire inventory immediately at whatever price they can get. They start selling everything at once. Prices drop sharply across the board. Other sellers panic, thinking something must be fundamentally wrong with the market, and they start selling too at discounted prices. Within an hour, prices are dramatically lower than they were when the market opened. But then something happens. Regular shoppers start arriving. They see the prices and can't believe what they're looking at. They know these goods haven't lost their value overnight. They start buying enthusiastically. Within another hour, prices have recovered most of the ground they lost. The wholesale seller's emergency had nothing to do with the value of tomatoes or honey. It was a mechanical disruption, a liquidity event, not a fundamental shift in the worth of the goods being traded. That is a very close analogy to what happened with silver. The fundamental picture for silver didn't change in the hours during which those prices dropped. The solar panels didn't stop using silver, the electric vehicles didn't suddenly stop being manufactured. The inflation concerns that push investors toward hard assets didn't evaporate. The supply constraints that limit how quickly new silver can come to market didn't disappear. What happened was a mechanical shock. And the market's response, how quickly buyers came back, at what price levels they showed up, with what degree of conviction, that response is where the real information lives. Now, here's what this means at a deeper level. When a flash crash happens, and the recovery is strong and fast, that recovery is not just a number bouncing back on a chart, it's a signal about market psychology. It tells you that buyers were watching and waiting. It tells you that the demand at lower price levels is real, not hypothetical. It tells you that the community of investors and institutions who believe in the silver story didn't get shaken out. They used the drop as an entry point. The speed and character of the recovery after silver's recent flash crash was one of the most closely watched signals among commodity analysts, and what came back was genuinely notable in both speed and volume. But to fully understand why that recovery matters, you need to understand what silver was building before the crash happened. You need to understand the foundation, because the foundation is what made the recovery possible. Silver is one of the most fascinating assets in the entire commodity universe, and the reason is simple. It lives in two completely different worlds at the same time. On one side, silver is a monetary metal. It has thousands of years of human history as a store of value. Ancient civilizations used it as currency. Central banks once held it as reserve assets. And even today, in the modern era where we've moved far from commodity-backed currencies, silver retains that psychological identity as a hard asset, something real, something tangible, something that exists independently of any government's promise or any bank's balance sheet. When people get nervous about inflation, about currency debasement, about the long-term stability of the financial system, they tend to move toward things they can hold in their hands. Gold gets most of the attention in this conversation, but silver captures a real and meaningful share of that same flow. On the other side, silver is an industrial metal, and not just any industrial metal. It's one of the most electrically conductive substances known to science. It has extraordinary reflective properties. It has antimicrobial characteristics that make it useful in medical applications. And it sits at the absolute center of two of the most important technological transitions happening in the world right now. The first is the shift to renewable energy, particularly solar power. Every solar panel that gets manufactured uses silver, specifically in the electrical contacts that allow the panel to convert sunlight into usable electricity. The amount of silver in each panel has actually been increasing in newer, more efficient panel designs, not decreasing. And the world is building solar capacity at a rate that would have seemed extraordinary even 5 years ago. The second transition is electrification of transportation. Electric vehicles use silver in their batteries, their charging systems, and throughout their electronic architecture in ways that conventional gasoline vehicles simply don't. As EV adoption continues accelerating, each new vehicle on the road represents incremental silver demand that has no equivalent in the vehicle it's replacing. Now, this combination, monetary safe haven demand and critical industrial demand, both active simultaneously, creates something genuinely rare in the commodity world. Most commodities are driven primarily by one type of demand. Oil is an energy commodity. Copper is primarily industrial. Gold functions primarily as a monetary and reserve asset. Silver is the unusual case where both major demand drivers are firing at the same time in an environment where neither shows signs of slowing down. Let's go deeper on the supply side, because this is the part of the story that often gets overlooked, and it matters a great deal for understanding why the price thesis exists at all. Silver doesn't just appear out of nowhere in response to demand. It has to be mined, refined, and brought to market. And the supply side of silver has characteristics that make it inherently slow to respond to demand increases. First, the permitting and development timeline for a new mine is measured in years, sometimes in decades. By the time the market signals that more silver is needed through higher prices, and a mining company decides to invest in new production, and they go through the permitting process, and they actually build and staff the mine, and they start extracting silver at scale, years have passed. The demand that created the signal may have already moved significantly. Second, a substantial portion of silver production actually comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This means silver supply doesn't just respond to silver prices, it responds to the economics of those other metals as well. If copper prices fall and copper mining slows down, silver supply takes a hit regardless of what silver prices are doing. This byproduct structure means the supply side of silver has an unusual lack of direct responsiveness to silver's own price signals. Third, the above-ground stockpiles of refined silver that exist outside of what's still in the ground, the buffer inventory, the stored metal that can be drawn down when demand spikes, have been declining relative to demand. This is a slow-moving trend, but a meaningful one. When that buffer is large, the market can absorb demand spikes without price moving dramatically. When the buffer is thin, the same demand spike hits a market that has less cushion, and the price response is more pronounced. The gradual thinning of that silver inventory buffer is a structural feature of the current market that amplifies price sensitivity in both directions. Now let's talk about the analytical frameworks that get analysts and serious investors to that $120 number, because you deserve to understand the actual reasoning rather than just hearing the target. The first framework is the gold to silver ratio, and this one has a very long history in precious metals analysis. The ratio is straightforward. It measures how many ounces of silver it takes to purchase 1 ounce of gold. If gold is trading at $3,000 and silver is trading at $30, the ratio is 100. If gold is at $3,000 and silver is at $60, the ratio is 50. Historically, over very long periods of time, this ratio has averaged somewhere in the range of roughly 15 to 50. In the ancient world, it was often close to 15. In the modern era, it spent a lot of time in the 40 to 70 range. But over the past several decades, and particularly during moments of market stress, the ratio has moved much higher, sometimes above 80, sometimes, briefly, above 90. Now here's why this matters specifically for the $120 conversation. When the ratio is unusually elevated, analysts interpret it as one of two things. Either gold is historically expensive relative to silver, or silver is historically cheap relative to gold. Many serious commodity researchers currently believe it's primarily the latter. They believe silver is genuinely undervalued relative to gold by historical standards. And the thesis is that as the market continues to mature, as more institutional capital begins to recognize silver's unique position as both a monetary and industrial metal, the ratio should compress. Silver should outperform gold on a percentage basis as capital flows into the cheaper of the two related assets. Here's the math that comes out of this. If gold is trading at levels consistent with where it's been in 2026, and if you apply a normalized gold-to-silver ratio that's more consistent with the historical range rather than the currently elevated level, the implied silver price lands in a range that includes $80, $100, and depending on your assumptions about gold's price and the degree of ratio compression, levels approaching and exceeding $120. This isn't speculation. It's arithmetic applied to historically observed relationships. The uncertainty is in when and whether the ratio normalizes, not in the direction the math points if it does. The second framework is technical analysis, specifically the long-term chart structure of silver prices. I want to address the skepticism about technical analysis directly because it's a fair and common question. Why should patterns on a chart tell us anything real about future prices? The honest answer is that chart patterns don't have predictive power because of some mystical property of the lines and shapes themselves. They have relevance because they reflect the collective behavior of thousands of market participants who are watching the same information and making decisions based on what they see. When a price level has stopped a rally multiple times before, traders and algorithms remember that. They set sell orders there. They use it as a reference point. The level becomes significant partly because enough people believe it's significant. With that framing in mind, here's what the silver chart has been building. Silver has a long-term base pattern, a multi-year consolidation where prices have moved sideways or in a controlled range, building what technical analysts describe as stored energy. The upper boundary of that base pattern sits near the previous historical highs around $50 per ounce, the levels that were touched briefly in 1980 and again in 2011. Each time silver has approached that zone, it has been pushed back. But each time it approaches, the character of the pullback has been shallower and the fundamental backdrop has been progressively stronger. This is what technicians call a pattern of ascending support. The base of each consolidation is higher than the previous one, forming a staircase structure that reflects gradually improving underlying demand even during periods of price weakness. The $120 technical target comes from applying a standard methodology called measured move analysis. You take the depth of the base pattern, the range between the floor and the ceiling of the consolidation, and project that distance above the breakout point. When analysts do this math on silver's long-term chart, the result consistently lands near $120. Different analysts using slightly different versions of this methodology get numbers in a range around that figure. But $120 represents something like the central tendency of these technical projections, which is why that specific number gets cited repeatedly across independent research. Now let's bring the flash crash and the recovery back into this framework, because this is where everything starts to connect into a coherent picture. You have a metal with a genuinely compelling fundamental case, growing industrial demand from two major technological transitions, persistent monetary demand in an uncertain economic environment, structural supply constraints, and an elevated gold-silver ratio suggesting historical undervaluation. You have a long-term technical base pattern that's been building for years, and then you have a sharp, sudden price drop, mechanical in nature, not fundamental, followed by a recovery that showed real conviction from buyers. In the context of everything we've just walked through, that flash crash and recovery sequence is confirmation, not contradiction. It tested the structure, and the structure held. The buyers who understand the fundamental story didn't run. They stepped in. And that behavior, buying into a sharp decline when the underlying story hasn't changed, is exactly the kind of demand behavior that tends to build the foundation for the next sustained leg higher. There's a psychological dimension to this that's worth spending real time on, because human psychology plays a larger role in markets than most analytical frameworks formally acknowledge. Silver has a complicated emotional reputation among investors. Anyone who was paying attention in 2011 remembers watching silver rise from around $20 per ounce to nearly $50 in what felt like a breathtaking run, and then watching it give back the majority of those gains over the following years. That experience left a real mark. It created skepticism, caution, and a reflexive distrust of bullish silver narratives that persists to this day. There's a generation of investors who heard the silver bull case in 2011, got excited, possibly bought near the top, and then lived through the long, painful decline that followed. Those investors are not quick to get excited about silver again. And this is counterintuitively significant for the current setup. Markets that are driven by widespread enthusiasm tend to be fragile because when everyone is already excited and already positioned, there are more potential sellers than buyers. Markets that build in the presence of persistent skepticism tend to be more durable because there's a deep reservoir of potential buyers who haven't yet converted. Every investor who finally accepts the thesis and buys becomes another layer of support beneath the price. The skeptical investors who eventually cross over tend to become strong holders because the decision took them longer to make. They've done more analysis, they've sat with more doubt, and by the time they commit, They're more convinced than a casual trend follower. Silver is genuinely volatile. And that is not a criticism, it is simply an honest description of the market. The same structural characteristics that can produce extraordinary upside moves also produce gut-wrenching flash crashes like the one we just walked through together. Being in a market like silver means accepting that there will be difficult periods where prices move sharply against you, where the headlines turn negative, and where the people around you question whether the thesis ever made sense. The investors who have historically done best in long-duration commodity theses are not the ones who were never challenged by doubt. They are the ones who understood the story deeply enough, the supply constraints, the dual demand drivers, the ratio dynamics, the technical structure, that when a flash crash happened or the market went sideways for months, they could evaluate it clearly rather than reacting emotionally. That is what this video has been trying to build for you, not a prediction, not financial advice, but a genuine, thorough understanding of the structural case behind silver right now, where the 20 target comes from, why the flash crash was a reset rather than a collapse, what the risks look like, and how to think about all of it as an informed person rather than as someone just reacting to headlines. The spring is still compressed. The buyers showed up when they were needed. The fundamentals are intact. And this story is far from over. Drop your questions in the comments below. I read every one of them. If this kind of analysis is useful to you, please subscribe and share this video with someone who is trying to make sense of what is happening in the silver market. This is John Smith, and I will see you in the next video.